warm welcome to one and all who has joined us today. I'm Tasneem and I'm the moderator for the session. First of all, thank you so much for joining us on a Saturday morning. Fundsindia welcomes you all to the webinar, and our today's topic of discussion is Power STP, how to make any time a good time to invest in equities. It will be hosted by Mr. Arun, who is the head of research team. So before I hand over the floor to Mr. Arun, I would request all the participants to put their questions in the chat box pertaining to the session. So the same will be answered by Mr. Arun once he completes the session. Over to you, Arun.
Hi, everyone. Thank you so much for joining us. We have a super interesting topic for today. So what I'll basically be doing is the first half an hour to 40 minutes, I'll briefly give a backdrop in terms of how we came up with this, what was the problem actually, and then what's the solution like. And after that, we'll open it up for questions. So that will be the format for today. So in essence, broadly, just wanted to, instead of directly starting off with the product, the features, and how does it work, really wanted to take a slightly different approach. I just wanted to tell you in terms of how did we actually come up with what was the problem and how did we try to solve this. So essentially, I'll take you through that entire journey of why this solution was discovered or was shown or was figured out, and why are we going ahead with this right now, right? So essentially what had happened was a year back, my mom was going to retire from the Indian Railways. So she was about to get a reasonably large sum of money as her retirement purpose. And she called me and then she said that, hey Arun, I might need a small portion out of it. But apart from that, the remaining amount of money, I will want you to manage. So this was what, and all of us remember that in the middle of last year, we were in the first wave and the market had kind of crashed by almost 40%. So she told me that we might be looking at getting the money somewhere close to around June, July. She was not too sure because obviously she was not able to go to her office and all that. But net, this is the context that she told me, right? Now, in terms of managing my own money, it's always been very simple. So I have very simple thumb rules that whenever my salary comes, I invest a portion of it via SIP, so that headache is sorted. Whenever I get like large sums of money, the simple thumb rule is that if it is more than 10 months of my salary, I do it via a 6-month STP. And if it is less than 10 months of my salary, I do it via 3-month STP. So that was as simple as what I used to follow throughout my life. But when it came to my mother's money, obviously it became a little more difficult for me because emotionally, the money suddenly seems to be like very, very important because this is her last large corpus that she's getting. And after that, it only be her pension. And she's not too comfortable with the equity market. This is the first time she's kind of wanting to experiment with it. So if I don't give her the good experience in the 3 years, 4 years, 5 years, then she'll be like, I'm much better off in gold and real estate. So this was the overall so basically at that point in time, maybe around April, the market had started to go up, but obviously the COVID numbers were up. We were all stuck at our home, and things around us were really looking bad. Now, both my wife, who is a small-time entrepreneur, she runs a dessert shop. She was also at home because obviously she was not allowed to open a store. So net, the news was bad. At the same time, the markets were going up. So the real concern was that whenever I get the money at some point in time in the next 1 or 2 months in last year, the real question that I was struggling with was what if so the overall idea was out of 100 rupees, I'll put 50 rupees in debt and 50 rupees in equity because obviously she's at 60. So the 50 rupees in debt is fairly simple. You just invest in debt and then you're sorted. The remaining 50 rupees in equity is where, while I know where to invest, like we will broadly distribute it across 5 different styles as per our 5-finger strategy. But the whole idea was, how do we invest? Like, should I put it one shot or should I distribute it? Now, that is where there was a confusion. So the first problem was that what I invest the entire amount one shot and then the market falls because you had seen in March that the markets had gone down close to around 40%. So that's the first problem. Then the second was that, okay, what if I wait, but the market continues to go up? When will I enter? Then it might become too late because as such, you get anchored to the lower prices that you find it really difficult to invest up. And this is something which I've earlier experienced. So I know that if I wait for too long also, I might miss out on the whole thing. So that was the second problem. Now the third problem was that if I stay with the money, okay, and then don't invest, and then the market starts to fall, then the problem is that when do we invest, right? Because every time there's a 10% fall, it looks like it'll go to 20. There's a 20% fall, it looks like it goes to, then we keep waiting, and then suddenly there's a move up, and you think it the falls upside, and by the time you realize it's already up. So a lot of confusions around how to invest. So the basic question was that should I invest now or should I wait for a market correction? So this was essentially the problem. So now I started off saying that how do we solve it currently? Like how do we solve it for our existing clients, and how do we normally go about with it? What's the industry do, and what do we also? Right? The simple strategy which has worked like really well across long periods of time is a very simple systematic transfer plan, where you say that, hey, don't invest it one shot. You stagger it out over a 6 month or a 9 month or a 12-month period. So the net, the idea is that over a year, whatever is the volatility, you will be able to average it out, and you will get a decent experience. The only small hit in this works really well. This is a very good solution, because if market falls, you have money to invest. If market goes also, you're still happy that at least your money is getting invested. You are not stuck. So the key reason why this solution works behaviorally is that otherwise we tend to freeze in terms of what is the decision to take. This makes sure that it is automated. The only small catch is that, like, let's say you started in Jan, and then in March there is a sharp fall, right? And let's say you have 12 lakhs and you've staggered it as 1 lakh every month for the next 12 months. In March, obviously it is down, let's say 30% or 40%. You will want to increase your amount. But if you put it as a simple STP, it only invests 1 lakh, 1 lakh, 1 lakh. So it was the same 1 lakh at 40,000 Sensex, the same 1 lakh at 35,000 Sensex, it was the same 1 lakh at 30,000 Sensex. So this is a fairly simple plan, but again, it leaves the nuances. So what it will essentially mean is that I will also maybe have to interrupt manually if there is a sharp correction. So these are very rare occasions, but if that happens, I will also have to manually interrupt. So the only thing was, this was not a complete put it there and then forget it kind of a solution. There might be few occasions where I might need to manually intervene and then do some transactions in that. Let's say I have to increase it if there is a market correction. Right? And then the second, so this was the first solution, right? And then the second solution was a simple product called balance advantage fund. Balance advantage funds are funds, and what they essentially do is that they keep increasing and decreasing the equity allocation based on the market condition. So these are funds which normally run their equity allocations anywhere between 30 to 80%. So that's how these balance advantage funds work. So if you really look at this particular solution, it works fantastically well. So let's say you invest everything in that. Let's say that 50 rupees I put it in balance advantage fund, and there is a large correction, it will automatically increase. But the only small catch with this is that though it is increasing when the markets are falling, what happens is that when the markets recover, historically we've also found out that balance advantage funds also start cutting the equity allocation back. So what happens is that out of my 100 rupees, only 50 rupees is into was supposed to be in equity, put it in back. So they increase the equity allocation, but they've again started reducing the equity allocation as the market goes up. So net, I end up somewhere close to around 20-25 rupees of my entire portfolio in balance advantage fund. So that was where probably I might want to manually intervene and then say, because anyway I bought it at lower prices, I might want to let it ride for a long run, because very rare that you get a 30% correction, because you're getting it after 12 years. The last time we got a 30% correction was in 2008. So when I get it at that prices, I don't want to be conservative. I want to let it run for a very long time. So again, balance advantage funds means that I might have to manually intervene. But the real problem was that all of these funds had a 1-year exit code, which means I have to pay a 1% extra to exit and then do a manual interval. So these were the two solutions, good enough solutions. But there was the small catch that maybe I might have to manually intervene. And then there is also this issue that there might be an exit load or a taxation issue for these two solutions. So this is how the existing solutions were stacking up, right? So the whole idea was, can we build something around this problem where like fairly I put the money in and then I don't need to do anything. Like irrespective of whatever is the market condition, I don't need to worry too much on what is the problem. But I put the money in this and then I choose whatever is the equity fund I want to build my portfolio in. And then this strategy will automatically solve for. So this was the starting thought process in terms of how we wanted to solve what is the problem and how we want to solve it. Now coming to the question saying, how did we go about solving this? So the first simple question was that then I went back to my team and then I told them that, okay, this is the problem. And then I had this small doubt that maybe maybe am I as Arun trying to be over intelligent and trying to make a problem out of nothing, right? So the whole idea was that the simple advice that is usually given across the world is that whenever you have the money, is the best time to invest, right? That's the advice that we normally hear, and I know that it works well over long periods of time and over maximum or majority periods of time. Okay, so the whole idea was I complicating it too much, trying to act like very intelligent? So that is something that which I wanted to check. So what we did was very simple. We took the last 20-year time frame, okay, and then what we simply did was we checked for the 5-year rolling returns had you invested at any point in time. So this is called the rolling return. So which means that what if you had invested in 1st of Jan 2000, 2nd of Jan 2000, 3rd of Jan 2000. So like that, each and every day had you invested, what was the 5-year return that you got? Assuming that the earlier advice that whenever you have the money is the right time to invest, right? So that means we have to check. And the good part is that this advice holds true majority of the time. So 70% of the time, you made a decent return. You made a return of more than 10%. Now, obviously, there were times when you made returns almost close to 50% CAGR, and there were periods where you made 25. So it's a range of returns, as you can see, but the dotted line is that 10% band. Okay, so anything about that is a return about 10%, which is a fair enough, good enough number. So broadly, the simple rule that whenever you have the time is the right time to invest works well 70% of the time. Now again, there are 30% of the time it didn't work, but then we all know that there are sharp corrections which happen occasionally. So last March was one example. So we said there might be times when the end date has a sharp correction, and because of which this number is getting skewed. So let's also extend it by 1 year or 2 years. So 5 years you hold. If your return is less than 10%, can I extend by 1 year, 2 year, and then see? In that case, the probability improved. So almost 80% of the time you ended up with more than 10. So simply put, 80% of the times you are making a return of more than 10% if you just hold it for 5 to 7 years. So which means that's like sorted. The real problem comes in the remaining part of it, where it is the 20% of the times where you don't end up making great returns. Now, unfortunately, when we show statistics, it's all fine. But the real worry for me was, what if my mother's money ends up in this 20% of the time? Because in 20%, see, obviously, at the end of the day, I can show all the statistics. But all that we are really worried about is if we are getting a large sum of money and we are the unlucky part of that 20% of history. Net, that is all that matters to us, right? So the whole question was, how do we how bad can it become during that 20%? Now, obviously, I'm showing you some extreme cases, but just to give a sense of what if we become really unlucky. So 80% of the times we will odds are in favor of us, but what if we get really unlucky? What happens? So this was a long stretch where we did not make money in Indian equity. So the period was in April 1992. Sensex was somewhere close to 4,460 levels, and almost for 11 years, it was more or less in this level. While obviously intermediary, it came back to these levels, but broadly you can say that the Sensex was kind of stuck. So it had a lot of rallies and a lot of falls during this period, but more or less you can see that almost for a 11-year phase, it was stuck around similar. So it took almost 11 years for it to completely crossed these 4,500 levels. While earlier it has crossed, again it crashed. So it was a 11-year phase. So this is how bad it can become if you get the entry point wrong. Obviously, this is a very extreme case, but just to give a sense of it. Again, in 2000, had you done the same thing, it took almost 5 years to get back to the original level. So it was close to around 6,000 levels, and it took almost till November not 4. So Feb 2000, it was around 6,000 levels, and almost it was in November not 4, it was again close to around 6,000 levels. So that's almost like 5 years. Again, in 2008, it was somewhere close to 21,000 levels in Jan 2008, from where there was a sharp fall due to the global financial crisis. And then it was more or less in those levels. It recovered in November 10, and there was a 25% fall, and again it slowly recovered. But net it almost took close to 6 years. So it was almost around Feb 14 types where it was still hanging around those levels, and then from there on we had the bull market that we saw over the last 6-7 years. So net, the problem is simple. These are obviously extreme cases, but these might be the 1% cases. But the real problem is, what if we are a part of the 1% problem? So that's how, that's the broad thought process. Can we solve for this 1% so that overall all of us will end up having a very decent experience in equities for a 5 to 7 year period? Not that we might always make the highest return, but I want a decent experience, and I want to make sure that I am not a part of that unlucky lot which got into a long period of no return. Because net, if for 5 years somebody doesn't make returns, or 6 years or 7 years somebody doesn't make return, obviously it's very difficult for us to hold it on for even more. Now, obviously, if you hold it on for 10 years, 15 years, you still make up for it, but behaviorally it is very, very painful, and we don't want to go through that. So that's the whole thing. So can we solve for this, right? So the first simple thing was this. Now, how do we solve for this? Now, the first thing that we have to do is, why does this happen, right? So why do certain periods alone go through long stretches of no return? So what we did was very simple. If you break down equity returns from a fundamental point of view, there are only three things that explain equity returns, right? There are just three parts to it. One is earnings growth, which is how much are your profits growing. Second is you are paying for the profit. So for 1 rupee of profit, usually in India, we pay around 20 times of it. So we pay 20 rupees to get access to 1 rupee of profit. That's the value. But in bad times, it goes as low as 10 times. And in good times, it goes as high as 35, 40 times. Right? So the valuations, the amount that you pay to get 1 rupee profit increases or decreases based on the current sentiments in the market. So that's something that we'll also have to be aware of. And the third part is a dividend yield. Now, dividend yield is simply around 1.5%. So 1.5% return is a fairly static component. So there's not much of uncertainty around it. So the real two problems are, how much is the earnings growth and how much is my value? Is the valuations going up or down? If it goes up, we get higher returns over and above the earnings growth. Valuation goes down, we get lower returns below the earnings growth. Now, earnings growth usually has a pattern where, like, for long periods of time, it will do extremely well, and for long periods of time, it will do extremely bad. So it's a cyclical pattern that we see. So usually, historically, over the long run, you ended up somewhere close to 10-12% earnings growth. Now, fund managers are obviously able to pick better stocks, so they end up with slightly higher earnings growth for their portfolio. So net 12 to 15% range is what we can expect if you are ending up with a decent set of good fund managers, right? So basis that we have like earnings growth of let's say 12-15% over the long run, or maybe even if we get it wrong, we might end up with 10 to 12%. So the key point is, if valuations are extremely high or extremely low at starting points, then that can give you an extra kicker or an extra detractor for your return. So the key risk that we found out in all, not just in India, globally, when we saw all these periods where there was a very, very sharp market fall or a stagnation period for a long period of time, usually it started with insanely high valuation. So in Japan, for almost 30 years, markets have not recovered. It happened because the valuations were insane. They were somewhere close to 60, 70 times, right? So any period that you look, most likely the culprit is valuations, right? So we wanted to test out. So this is the thesis with which we started. This is how globally it has worked out. And even in India, a few cases it worked out. But yeah, we wanted to test this out. So what we did was, we wanted to proxy valuation. So what we did was, we took the 4 most commonly used valuation metrics. These are proven valuation metrics. We didn't take a single metric because all these metrics have their positives and minuses. Once you combine these 4, we have seen that gives you a good sense. So we are not getting biased by the bad part of one metric or the good part of one metric. So overall, when you combine them, the results are always far, far better. So what we have done is, we've taken these 4 and we've combined that into, we've given them equal weightage, and we've put them into a number between 0 to 100. So net, if it is close to 100, it means compared to the last 10-year history, that valuation range is on the higher side. And if it is low, if it is closer to 0 compared to the 10-year historical range, it simply means that the valuation is on the lower side, right? So net, closer to 0, lower valuation, closer to 100, higher valuation, right? So let's check how this thing works. So what we simply did was, we took a 5-year rolling return periods for all the last 15 years. And then what we simply did was, for if you had invested in a lump sum amount in these different valuations band, what was the returns that you got? So our key question was, at high valuations, if you invest, are you getting lower returns? Now our thesis proved correct. So as we saw in the average return, you can see that if you invest at lower valuations, you get a huge, almost a 16% kind of an average return. But you invest in 80 to 100 band, your average return drops to 4%. And here comes the killer. There's not a single instance where you made more than 10% CAGR over a 5-year period when you invest between at the highest valuation, right? So this is not to say that definitely this will repeat in the future, but this broadly gives us a sense that, hey, if I am starting at a higher, it is natural, right? When you're buying something very expensive, then the expensiveness should continue, or otherwise, if it becomes normal, you know that that part of the return is taken away from your overall earnings growth that you earn. So this is from a thesis point of view and from a practical point of view. History shows us that at higher valuation, the odds of you making a higher return is very, very low, and that is what we've seen. So almost like 0% chance of making more than 10% in history, and also most of the time you ended up with a return of less than 7%. So 94% of the time you ended up. So this is the primary danger point. So overall, the thesis is simple, that more the expensive the valuation, we have to be a little more cautious. So now that we knew this, then we were like, how do we put together a solution? Okay, so now the next question is, what is it showing in terms of the current valuation band? So right now the valuation band is somewhere close to around 76, which is not on the very expensive zone, but definitely on the expensive zone, right? And neutral is between 50 to 70. So we are not neutral. So we are definitely on the expensive side. Okay, which means that this is again one more worry point for us to worry, especially if we are bringing in large amounts of money now. Okay. Now the key question is, how do we solve for this? So this was how the thought process went. There was a problem in terms of how do I invest a large amount of money. We had some existing problems, existing solutions with small hitches. Then we found that valuations are a big determinant of the final returns that you get. Higher the valuation, higher is the chances that you might end up in the bad side of statistics. And so how, putting all this together, can we come up with a solution which is fairly hands-free? You put it and then can it solve it for us? So that's the broad thought process, and that's how we came up with this concept called Power STP. So what does the Power STP do? Simple. So first thing is, I have a simple STP which works like phenomenally well for me till date, right? So first thing is, it's not like I'm saying, hey, STP is bad and I am going to completely invent a new solution. All we are saying is the STP works phenomenally well, behaviorally well. So we take the best part of the STP, which is that you don't put it one shot, but you stagger it out over a period of time. So what we did was simple. We decided that we'll take the best part of STP, which is that we'll stagger it over a period of time. Now, what is that period of time? Roughly, any equity investor should at least have a 7-year time frame. So 15% of the time, which is almost around 1 year. 1 year is a decent enough time frame to deploy a large sum of money. So think about it like a flight takeoff. Instead of like immediately going and starting a flight, there is a small takeoff period, right? So that takeoff period can be close to around 1 year. Okay, so the whole idea was simple. Whatever is the amount that you have, let's say it's 12 lakhs, you put it in a debt fund, and then you split it into 1 lakh each for each and every month, and then let us deploy it over a course of 12 months. So this is what a simple STP does. Okay. Now, as I told you, the real problem is that if there is a sharp market correction or a sharp market going up and valuation is becoming insane, the simple STP doesn't know. It will continue to invest 1 lakh. But we said, can we make it a little more intelligent, like what the BAF does? What does BAF do? BAF will quickly increase your allocation if valuations are cheap, right? So that's exactly what we did. So what we did was, we overlaid the valuation parameters on top of it, and we simply said that, hey, I won't make the monthly allocation static from the debt fund, each and every one based on valuation. If the valuations are lower, I will invest a higher amount. And if the valuations are higher, I will invest a lower amount. And if the valuations are expensive, that 80 to 100 band, I'll say pause. I won't do anything for that month. I will wait for 1 more month and see if I get a decent price coming forward. So that's the overall thought process. So how does it actually work? Very simple. In the very expensive zone, what we do is we take a pause. We don't invest anything. So your 1 lakh, which was supposed to go for that 12 lakh, which you had split as 1 lakh each for every month, you don't invest anything. And if it is in the expensive zone, which is currently it is in the expensive zone, instead of 1 lakh, you only invest 50,000. So you invest half of it. And if you are in the neutral zone, you simply continue with the 1 lakh, which gets invested every month. And if it is super cheap, then you do 3 times of it. So you quickly invest 3 lakhs instead of 1 lakh. And if it is very cheap, like what it got in March last year, you invest 6 times of it. You invest 6 lakhs. And so which means 2 months you get a cheap price. One shot, you're done with the whole thing. So in 2 months, you're deploying the entire 12 lakhs into it. So the simple idea is we are combining the best part of BAF, we are combining the best part of STP, and the key point is we are deploying it and then we are letting it run. We are not saying that again we will try to reduce it at the initial increase which happens in equity. Get it at the right price, then we are like let me move away from it and let the equities run in peace for 5 years. So that's the overall idea behind it, because either way we have a debt allocation which is a part of it, which is anyway conservative and which will take care of the safety part of the portfolio. This is the overall idea. Now, this is how it's broadly worked. So this is historically, if you look at it, when markets had fallen in global financial crisis, it invested almost 6x. Again, in 2013, there was a taper tantrum, which is like Fed had announced that they will be stopping their QE and then the interest rates might hike. Then markets got very panicky. The currency almost went to currency went crazy. There was a huge currency crisis brewing, and at that point, the market cracked, and then we quickly put 6x of it. And then again, there was a China-led problem in 2016. Again, it went to 6x. Again, in COVID, it went to 6 times. And you can see that most often than not, it is somewhere around 1x. And there'll be times when it reduces the allocation. So it's a very simple concept based on valuation. Overall idea is based on the market condition, can I dynamically move it and then deploy it over a period of 1.5 years. Now the timing will depend. If it is super cheap, it will deploy it fast. If it's super expensive, it will deploy it slowly. So now can we see some examples so that like we really get it? So I'll take the extreme example first so that it's very, very evident. 2008 was probably the worst ever time that anybody could have started investing, because it was at 20,000. And we know that almost for 6 years, you didn't make money in market that you invested at these levels. What this STP did was, so let's assume you had 12 lakhs to invest for simplicity's sake. First month you did not invest anything because it was at 95. Feb again 93, you did not invest. March you did not invest. April you did not invest. In July only you started to invest. So you invested close to 50,000. Though it was at neutral levels because the momentum was not favorable. So we were investing only 50,000, which is half of what was required for every month. And it was only in November, not 8. It invested 3x. In December again 6x. Jan was 6x, but only we had 1 lakh remaining. So invested 1 lakh. So what does this finally give us? So you can see that the Power STP's entry point was somewhere close to 10,000 levels in Sensex, while the lump sum's entry point was 20,200. And you did a simple STP, you would have entered somewhere close to 15,000 levels. So we got a 50% discount to lump sum in terms of your entry price. And we got a 32% discount in terms of simple STP. So net in terms of returns, almost 18% returns in Power STP, vis-a-vis a simple STP of 9% and a lump sum of 0%. Now, this is an extreme case, but obviously, if you had followed valuations, it would have worked well. Now, the key point, let's take a normal scenario like December 2010, where again the same method was followed for across different months. And you can broadly see that the entry point was at 17,400 was the Power entries entry point in terms of Sensex levels. In lump sum, you got it at 19,500. So you got 11%. Now, this is the normal case, like, because that was extreme. Like 2008 crash is like a very, very rare crash, but those times Power HTP will do phenomenally well. But these are like normal correction. In a normal correction, you end up with a decent outperformance. Over 5 years, you made 11%, while lump sum made 7%. A simple STP made 10%. So you get a slight discount and you are able to buy it at a 11% or 5% discount compared to a lump sum or a simple STP. Then pre-COVID, let's say you started in Jan, again because you got a sharp correction and a sharp entry point, you got almost a 18% discount. So instead of 41,000, which was Jan levels, you were able to enter using Power STP at 34,000 levels on aggregate. On average, you entered at 34,000. But on a simple STP, you entered at close to 37,000. So simple STP still is a good solution. It's not like a bad solution. But yeah, but this because it gives that valuation quick kicker. you are able to get a further discount. So overall, 18% discount vis-a-vis the lump sum and 9% discount vis-a-vis the simple STP. On a return basis, it's significant, right? So almost 40% is what you made if you had invested in Jan. Vis-a-vis the lump sum is close to 16%. 16% is not bad, but net, this is the figure that a valuation overlay gives you. So now the key question is also, this is how it works. Now the fundamental starting point is, does it work well across periods? Now we know that all these periods where the market cracks, the solution works well, because that's essentially the idea of the solution. Any market which is correcting, you will get a phenomenal outperformance from this solution. But does it work well over long periods of time, over different phases? So this is a 5-year rolling return, which is like all dates you invest, what was it that you get? The blue line, as you can see, is fairly consistent, and the dotted line is a 10%. So broadly, you have seen that 70% of the times you have made more than 12% returns, and 90% of the times, roughly, you have made more than 10% returns. Vis-a-vis a 60% odds for lump sum in terms of more than 10% returns. In terms of more than 12% returns, it was only 50% for lump sum, right? So both 12% returns and 10% returns, the odds of getting it, this is increasing it. And the key part is, if you extend it by 1 or 2 years, even those 10-13% of the time you're getting lower than 10% returns, the markets have recovered and the solution is able to give you a return of more than 10%. Right? So net, broadly, if you really look at it, the first thing that we wanted to do was, can we avoid that bad 1-2% or the chances where you end up with bad returns, right? So this is, if you look at it broadly, this satisfies our first criteria, which is that overall, I'm able to end up with a decent return if I have a 5 to 7 year time frame, and 12% and more 70% of the time, which is very, very good enough for me. And an average outperformance around 2%. Now, obviously, averages hide a lot of things. You also need to realize that there are a lot of periods where it will underperform. So 2 out of 3 times it's outperformed, but 1 out of 3 times it's underperformed. So it's not a solution which says that I will always do better than lump sum, because if markets are cheap, lump sums will do better. If markets are expensive, Power STP will do far better. So you can see that there are periods where Power STP has underperformed. So it's not like a magical solution which will always outperform. There are periods of underperformance. 1 out of 3 times it is underperformed based on history, but but 2 out of 3 times it is outperformed. So that's so don't just go by the average number, because averages hide the nuances of any product. Again, we compared it with simple STP. Does the same thing, like about 12% CAGR, the probability increases from 40% to 70%. Again, about 10% CAGR, the probability increases from 66% to 87%. Right. So just like what we saw in the previous slide, again, average outperformance is also close to 2.5%. But in terms of vis-a-vis a simple STP, more or less it is able to outperform for a larger period of time. There are only very small phases where there's a minor under. So it does really well vis-a-vis a simple STP, simply because it adjusts based on valuation. So overall, the performance has also been like fairly, very, very decent. So it kind of satisfies that primary criteria, that will it improve my odds of a good and a decent return outcome. So great. So this is all that. Now the real question is, we are really worried saying, well, how does it do during a very, very expensive phase, right? So we did the same thing. So we looked at the expensive phases and we saw what is the probability of getting more than 10%. So if you remember, there was a 0% probability of getting more than 10% in a very expensive zone. Now it's gone to 100%. Similarly, in expensive zones, it's again gone from 54% odds of getting more than 10% to almost 100%. So overall, the simple idea is that at expensive phases, the Power STP does really well. And during very cheap phases, it's almost equivalent to lump sum, because this will also deploy fast. Lump sum will also do it once. So there's not much of a difference. So as you can see, there's not much of a change it brings in the cheap zones. And in neutral zones, it improves. It improves, but not to an extent where it does in the expensive area. So the next question is, should I only do it in expensive valuation zones and leave it in very cheap valuation? Should I do a Power STP? Now, simply put, in cheap valuation, you can put it as one shot. But even if you do a Power STP, what it will do is it will do 6x, right? It will do 6x, which means in 2 months you have deployed. Even if it does 3x of the monthly STP, in 4 months you are deployed. So more or less, it acts like a lump sum during cheap valuation. So if you want, you can do it lump sum. If you're too worried, if you're too concerned, you can give it to Power STP, and it'll more or less act like a lump sum. So net, it's like an all-season product. You don't need to think too much. You just give it to the solution, and it will automatically aggressively deploy or slowly deploy based on the market conditions. So overall, what's the time that usually it takes? It's a 1 year is what we planned, because like if the valuations are neutral in 1 year, it will get deployed. But if it's expensive, it might take a longer time. It might take close to 1.5 years or so. And then if it is super cheap, it will get it done in 4 months to 6 months kind of a time frame. So overall, if you really look at it, the simple idea of the solution is that if you have a 7-year time frame and you're getting a large amount of money, let's say for retirement, or you've sold a property and you've got it, and you're really scared on how to invest in these markets, these kind of solutions help you. You can choose any product that you want in terms of equity fund, and this will ensure that it is gradually deploying it based on the market conditions, so that you're avoiding the risk of that bad outcome that happens 1% of the time, 2% of the time, that you want to avoid. Because like, while statistically it is a low number, we don't want to be a part of that. And there are also one more set of investors who've taken the money out last year thinking that the markets will fall, but the markets have gone up. And now there is obviously a lot of money accumulated, because in the last 1 year, most of us have not been able to spend as much as what we normally do. It's very difficult to get the money back in, because you're worried saying that if it falls, then I might look really foolish. So for those investors who want to deploy the money back, this can be a fairly decent strategy to get the money back in. And so for anybody who's concerned saying that, hey, valuations are high, there might be some problem happening, the COVID cases are increasing. So if you're worried about that, this can be a fair enough, decent strategy to deploy your money staggered over a period of time, and using valuation as a primary tool of deploying higher or lower amounts. So the key point is we also need to look at, so any product that we take, we also need to ask ourselves, what is the pain that I will have to go through? Because there's no magical products ever, right? Any product that you invest, there'll always be some pain that is required to be taken from our side. In this case, the real problem is if valuations are high, the solution won't deploy initially aggressively. But if the market continues to become higher and higher, more and more expensive in valuation, and giving higher return, then you will miss out on it, because we will be still in debt, and we'll be deploying it slowly. So this is the biggest risk. So for anybody who's looking at this product, the first 1 to 3 years, depending on the market conditions, might disappoint you. Might, if at all the valuations are high and there's no market correction and the market continues to become more and more expensive, this product will definitely underperform in the next 1 to 3 years. So this is not a magical solution. So if your view is that the market will definitely go up, then you have to do a lump sum, or you do a simple STP. But if your view is that I'm a little worried, then this can be a solution. So this is the key risk to be aware of, especially in bubble market phases. So there will definitely be a disappointing phase. Historically, that's how it's behaved, because it is very slow, takes its time, and it waits for a sharp correction, all the valuations to come down before it becomes aggressive. So who shouldn't invest? If you have less than 7 years, it won't give you a great experience. 5 years is enough, but we need the 2-year leeway just in case if you have a sharp correction in the last leg. And then this is not a maximizing return kind of a product. The primary idea is to remove the odds of a very, very bad outcome that I might end up with. So the overall idea is 2 out of 3 times it's beaten a lump sum. But net, the idea is not to say that I will always beat lump sum. The idea is that I will give you a decent return experience over a 5 to 7 years. And the third key part is that if the 1 to 3 year performance is not great, if you're somebody who will get really worried about that, then this might not be a great solution. So it will definitely underperform if the markets continue to go up despite it being expensive. Now, if it is cheaper, it's not a problem. It will quickly deploy. But only in that single case where markets are already expensive and it continues to become more and more expensive, the product will simply, it won't want to invest your money at higher and higher valuation, because then the whole objective is lost. Because all you're saying is that please make sure that my entry point doesn't give me that really bad experience. So if you want to avoid that risk, this will obviously be a lot more patient to deploy your money. But most of the other times it will deploy it in cheaper times, it will deploy it as quick as possible. So the process is very simple. It is all completely automated. All you have to do is select the equity fund in which you have to invest. 1.2 lakhs is the minimum, because the idea is 10,000 at least has to be the STP value, given that all funds have a certain minimum criteria. So you choose a STP fund, and then you choose the corresponding debt fund, which we've given as a list. Mostly it will be the safest funds like liquid funds or ultra short term or money market funds. or maybe the overnight fund, and then you set the STP and then everything is taken care. All you need to do is for 12 lakhs, you say 1 lakh per month, and then automatically based each and every month, the transaction is done on 7. It'll automatically take a call based on what the Fundsindia's value meter gives, which is our internal model. And based on that, it'll either put 0x, 0.5x, 1x, 3x, or 6x. So there are 5 different bands. It'll base what is the value. So sometimes it will be 0 rupees which is transferred. Sometimes it will be 50,000. Most of the times it will be 1 lakh. Sometimes it will be 3 lakhs. Sometimes it will be 6 lakhs. So all that will depend on what is the opportunity that the market gives and what are the market valuations in the next 1 or 2 years. So that's how it will essentially. And then you don't need to do anything. It will automatically get deployed in the fund that you have chosen over a period of 6 months to 1.5 years, depending on the market. So as simple as that. So overall, summing it up, very simple product. If you are really worried and you have a large amount of money, you are really worried saying, how do I deploy my money? This can be a good strategy. Along with currently you have a simple STP, you have a BAF as a solution. So this is the third solution, which combines the best of both these solutions, where the key idea is that if there is a market correction, you get to deploy more aggressively. And if the valuations are high, you get to deploy more slowly. So the full summary is given here. So I'll keep this slide open. Overall, it's a very fairly simple strategy to deploy your money. And please use it only if you have a large amount of money. If it is very small amount, let's say 1 times of your monthly salary or something like that, you don't need to complicate your life too much. There's no harm. But the real challenge is that if you're getting a large amount of money, because this is more of a safety first kind of an approach. And for small amounts of money, if the market moves up, you might be disappointed. Like either way, whether it's going up or down, it really doesn't matter too much. So think about it more like a KBC contestant going for a 20 lakh question vis-a-vis a 7 crore question. So in the 7 crore question, if you answer, you get 7 crores. If you don't answer and you quit, you get 1 crore. But if you answer it wrong, you get only 3.2 lakhs, right? So if the money for you is more like the 1 crore, more like the 7 crore question KBC, there are a lot of KBC contestants who knew the answer and yet quit because they wanted safety first, because 1 crore is a large amount for them. So look at this product like that, where it's not a 3.2 lakh question. It's more like a 7 crore question. So if safety is is the highest priority, then this product makes a lot of sense. But if it's a small amount of money, don't overcomplicate your life. You do a simple 3-month or a 6-month STP. That should be more than enough. Or you do the same app solution that I told. But yeah, this is like a complete hands-off solution, which will automatically increase and decrease your amounts based on the market condition.
Yeah, thank you, Arun. And thank you, participants, for staying with us, and hope the session was useful. And take care.